Hello, this is Chris O'Shea of the Financial Consulate. We're here to do a webinar today, and we are going to be talking about the influence of the Federal Reserve versus the elected officials, the national ones, Congress and President. Who has the bigger influence? And so I've been with the Financial Consulate going on 23 years now. I serve as the financial advisor and chief investment officer. I'm a CPA and certified financial planner by training. But you've often heard Drew and I talk about the Federal Reserve and the influence that it has, and a lot of folks are impacted, as we are. We hear day after day the influence that the president and the legislative branch have on the economy and markets. And so we're going to explore that today in some detail, more than what we can typically give it. It's not going to be exhaustive, and I'm not a constitutional scholar, but we are going to there's some basics that we need to cover to do that. So I'm going to share a screen. We're going to go through some slides. Let's have some fun. Let's just explore. I mean, this is fun to us. Let's explore this topic in some further detail. So I'm going to, there's the title, and we're going to be just going through some slides. And so we're going to start with the more important or more influential, and that's the Federal Reserve System and how it came about. And then we'll look at Congress, we'll look at the president and their roles. And they're not completely independent, but who does what, who tries to influence the other, who does influence the other, and who has the most impact on financial markets. So how did the Federal Reserve System come about? Well, in the 1907 panic, of which there have been many in the history of the country, but that one was significant enough that they said by the time 1913 came, the passage of the Federal Reserve Act. So that act established the Federal Reserve and the Federal Reserve System, and it's been amended twice since then. So 1933, the Reserve Act was amended after the next financial crisis, the stock market crash of 29, and the ensuing beginning. What they didn't realize was the next really 25 years before the market would come back to the levels where they were, but the Great Depression. And so they amended the act to create the Federal Open Market Committee, the FOMC, and that's still in existence today, still a major player. And then in 1977, the act was amended once again to require the FOMC to promote the goals of maximum employment, stable prices, and moderate long-term interest rates, because at the time, inflation had become such an issue, and it wasn't until a few years after that that inflation was really gotten under control. So the mandate came. So again, the act, Congress has the power to amend it. They have the power to amend it today. So they do hold significant influence, but in order to, as you could see, there's only been a couple of times that the act has been amended. There has to be maybe not unanimity, but there needs to be a pretty overwhelming support for this to get passed. You've got to get, just through any significant bill, you've got to get the president and you've got to get Congress to do that. And knowing what a huge issue it is, Congress at times has flirted with doing more, but they have not done anything for 45 years. So in the beginning, it created the Federal Reserve System to manage the country's money supply, to make loans, provide oversight to banks, in addition to be the lender of last resort. The 1933 Act, at that point in time, said, okay, we need to do some things. Let's put into place the Federal Market Committee. We're going to broaden the influence of this and the participants, and how this specifically acts day to day to do open market operations, because this is what affects the money supply, which we'll see, which is two main points of the entire presentation today. The webinar is the role of money supply and credit in the system. Those are the overarching influencers in the economy and the US and the world markets. So the 77 Act, inflation had been raging for some time, and so they came up with the dual mandates, full employment and low inflation. You'll hear that still referred to today. some things, some people trying to get the Federal Reserve and the chair recently. This is being filmed on January 19th. So actually January 20th. So there are things where they're trying to get the Fed to influence climate change and other desired goals that Congress has. But that's not an adoption. There's no mandate to do that. So it'll be interesting to see how that plays out. But those acts, again, they have the ability to amend the Federal Reserve Act. So Congress, of course, is empowered by Article 1 of the Constitution. And they have some significant powers, right? They have the power to lay and collect taxes. These are the financial powers. And of course, spend them. They regulate commerce domestically and abroad. That was how we interact with the world. To coin money, regulate its value, to borrow money on the credit of the United States. And this is the one where a lot of clients, a lot of market observers, just observers of Congress, really get concerned about, because the level of debt that the country has amassed at this point in time. We're going to look at some charts after we go through just some of the foundational things here. And we'll look at, okay, where do we stand now versus where have we been over time? What kind of money is Congress spending? What does that look like? What are the long-term implications? So we will certainly look at that. And as I've said, they have the power to amend the Reserve Act itself. The President, Article 2 of the Constitution, we've checked off the box now. We've got the legalese of who's empowered to do what. Among other things, the power to execute and enforce federal law. And of course, the President can and does lobby Congress to achieve legislative goals, and more often sign executive orders and implement other policies through administrative actions if they get Congress that is not compliant to their goals. But then the court system, you get the third branch. The judicial branch has stepped in more and more to try to say, wait a minute, you've overstepped your authority. That's happened a lot over the last few administrations. We expect that just to continue. So the role of credit in the economy cannot be overemphasized here. You just need, as we remind ourselves, how have you bought houses? How have you bought oftentimes cars? How have you financed maybe children's education? Some people do that with cash. Some people say, well, if you buy a car and you can't pay for it in cash, then you can't afford it, right? Well, depending on how you do that, cars are always a matter of how can you lose money the slowest, but if you finance it over a shorter period of time than what it's going to last. Houses, of course, you're buying that through credit. People are starting up businesses. People expand businesses with credit. Most of the assets purchased in the United States were financed with various levels of debt. And, you know, we have people certainly starting out, this generation that is now in their 20s and 30s, they're coming to the table with oftentimes less down payments because it's just so expensive to live. And now housing prices are soaring. So debt is huge, but it's not just personal debt, but debt for companies, again, especially small businesses. Such a huge portion of American economy is influenced by small business, and that is done with debt. Congress has really nothing, you know, they can regulate how people lend money, but they do not create money. They do not create jobs. They either help support the creation of jobs or they work against it. But business and money, banks, the Federal Reserve, the biggest bank behind that, are the ones that it's been likened to the oxygen that you need in your body or the blood you need in your body. The oxygen and the blood flow lifeline of the economy is credit. And so we'll look at that a little more. This is just really starting out. So I'm going to talk a little bit more about credit, talk fundamentally. And you know, banks and finance companies do the actual lending, but the base rates are set by the Federal Reserve. And then all the rates kind of come off of that. Your home equity loans. You think about the prime rates are set by banks. Prime rates are typically about 3 percentage points above what the federal funds rates are, which are between 0 and 0.25% right now, really zero. Your bank accounts are getting 0.01. That's not because banks are just stingy. It's just because the Federal Reserve is setting rates. Online banks are paying more because they don't have the overhead that the brick and mortar banks do, the M&T Bank and BB&T. And so they can pay a little bit more, but still rates in 2018, the latter part of the year, online banks are getting 2.5%, where regular banks are getting 0.1. Now here you have the Federal Reserve has lowered rates, and you're getting 0.01 on banks, and some of the the online banks are paying you 0.5%. That's pretty much the max of what they're doing. So the role of credit, well, banks make money when they lend money. I mean, there are points of time when when banks try to lend money and no one's borrowing. There are times when the banks aren't lending any money. 2010, 2009, banks were not lending any money. People that I was involved with an organization that people were knocking on our door to lend us money. 2006, 2007, 2008, 2009, and 10, they literally would not even return phone calls. So there are times, and that's the old adage that it comes from truth, is when do you, when will banks lend you money is when you don't need it. When times are good, they've got, they're very flush with money, and they want you to take it because the risks are lower. And you say, well, I don't necessarily need as much money now. Is when you don't need it. When you really need money, when times are tough, banks are not lending it because their lending practices are getting restrictive because it's been a boom bust scenario. They've overdone it. Now they've got to pull back. But banks make money when they lend money. And so fundamentally, so follow this for a little bit here. So people buy more. If you can only buy more if you borrow, because you either have to save more money and then you can spend more, but you're going to borrow. So that increases your spending capacity. As you're borrowing money, banks are making money. Times are good. Banks are then allowed they can lend more money, which then helps the economy because it's putting more money in people's income because the economy is going well, especially people that have businesses that are benefiting from people buying their products. So people's incomes are rising, which allows them to borrow more money. And the cycle just keeps repeating itself. So the banks are making more money, people are making more money, incrementally the economy is growing, credit, your chest is expanding, the economy is expanding, the pie is getting bigger, tax receipts are growing, everything is just is flowing better. That's why some people have said, all boats rise when the economy is rising because people's incomes are rising, and then banks are making more money, governments are getting more tax receipts they can spend. So the process of credit, though, is what underpins all of that. And if the reverse starts to happen, where people start to pull back and now people are lending less, people are they can't spend as much, the economy starts to shrink. And some of that is just natural. You'll see the ebb and flow of cycles. But recently we've had these boom and busts, where 2007, 2008, and now the economy goes through this wrenching contraction. And so spending drives economic growth. It just does. So with a lot of that as a backdrop, now we're going to say, okay, well, what about, we hear all that, what has it actually done? Let's go back and look at some charts. And so this chart's going back to 1930, and it shows federal receipts as a percentage of gross domestic product. How much money are the officials, Congress, raising through taxes, because that's the baseline of the starting point of where they're spending money. So receipts as a percentage of gross domestic product, you see it shot up to finance the war. In the 40s, that's when payroll taxes began. They realized that, hey, rather than people pay quarterly estimates, we're going to take the idea of the businessman in New York, and we're going to deduct things from people's payroll. We're going to finance the Pentagon because we've got this war effort too. So you saw the federal receipts as a percentage of gross domestic product, just surge, and so it has never really gone above that. And so it financed the war. And you see over time, there have been, it ranges anywhere from 13% here in 1950 up to 19% there in around 2000. But the influence hasn't been that great. The more money that the government takes as a percentage of gross domestic product, the more they are regulating, the more they're taking away from the free flow, free market capitalism. So right now, where it stands, that's not a huge number. Well, we look at the next chart and it says, well, what about the federal outlays? Well, outlays are what they're collecting and then what they're borrowing. This is the thing that gets a lot of people worried. And the way Congress can spend money, there's good reason for that. So again, you saw that the outlays jumped up, but the outlays drop, and they start to increase again over time. They increase again here, 2009, 2010, the crises. You see the areas in gray are recessions. So these are recessions. So when the 2008 crises hit, the Federal Reserve came to the rescue to just lend money. And then they did that on steroids in 2020. You see that they opened up so many programs to lend so much money. Even at that point in time, municipalities were saying, wait a minute, this is a global lockdown. Receipts are going to be hit. Economic activity is slowing down. It was a panic. The Federal Reserve stepped up, and they were the borrower of last resort. They were lending money to everything, and so markets calmed down. So that is right there a big number. If that number continues, then that's where countries in history have gotten into significant trouble when the outlays just go higher and higher and higher. Japan is a forerunner to us. Their numbers are significantly higher, and so we can look to them as well as others, but they're the most recent group that has really gone way beyond us. So gross domestic product, not going to spend a lot of time on this one, but again, you see there are times when it slows down here during the 2010 recession, but the economy continues to grow, and with that, receipts have grown. You would think that there's enough money that we don't need to spend more. But again, there's so many needs that the public wants to have supported. And so they lobby for them. And so more money gets spent when there's not really realization for some of the liabilities, things we've already committed to, Medicare, Social Security. There's just things that are baked into the equation. And so federal funds rate. And so we're going to look at this on the next screen also. So the federal funds rate has dramatically changed over time. That's what the Federal Reserve impacts. So what I wanted to look at it is in this realm, because this realm also wraps in here inflation. And so we'll hit a couple of things at the same time. And you also see that there are recessions. So in green, that's what the Federal Reserve has a direct influence on. They set the rates through their operations on the federal funds. This is what banks have to pay to borrow money. So you'll see in 1980, red, which is inflation, goes from 5%, it starts heading up, it's at 10% now. And so it's become a political issue. It's become a pocketbook issue. It was exacerbated by the oil crises of the early 70s and late 70s, but the markets were concerned. The markets then took longer term rates significantly higher. They didn't think that the government had the wherewithal to change their policies to really get and realize that, wait a minute, we can't spend the money like we've been spending. We can't have rates as low as they are and facilitate this, this demand, which is outstripping supply, which is the same thing that's happening now in the US because of the supply disruptions and then all the money that's been given to individuals that you get a lot of people are demanding certain supplies, whether it's housing and other things that the demand is outstripping supply, and you've got inflation that has hit us. And so markets are still coming to grips with that and thinking at this point that after 2023, 2022 and into 23, you're going to get supply and demand equalizing more and more normalizing as more people open up and catch up. But in this particular case, markets did not believe that the U.S. had changed its policies, that the Federal Reserve would just loosen rates because the pain is too much. Politicians the outcry would be too strong, and the impact would be too devastating. So it took a while for inflation to start coming down, because part of inflation is people's expectations. if you think prices are going to go higher, then you're going to buy now. And if you think prices are going to forever go higher, it's a self-feeding process, then you buy now. So that you're taking demand from the future and you're putting it now, and supply isn't there, and so you're shooting prices up. Versus if you think prices are going to come lower, you'll hold off on your purchases. And so if you think inflation is never going to come down, you're buying now, which helps fuel the process. So it took a lot of pain, and it took a very strong head of the Federal Reserve and Paul Volcker, who Jimmy Carter appointed, and they realized that he was serious. Rates went up to, here you've got 18%, 19% is where federal funds went to. Mortgage rates were at 15%. The pain was there in the early 80s, the contraction that hit. This recession you see here is a little wider, it's a little longer. It's like the 2010 was, it's not quite as wide as that, but it's wider than the one that had happened, just before that. And so it really had an impact because rates were so high, the cost of doing business was so high that it just shrunk things, and people started to adjust. Okay, we see that the government is serious. It isn't this easy money forever where demand is always going to outstrip supply. So the Federal Reserve had the impact. Now the numbers in red, inflation is dropping. It's 6 and 7%. Now it drops really quickly down to 2.5%. And of course, if you lived through it at the time, it was not quick. But once it took hold, you've got fluctuations in here. But after 1990, inflation now is at 2.5% and staying there and dropping even, below that. And so you had rates go up higher here as Greenspan in the irrational exuberance part. That's actually back here in 2000. And then when 9/11 hit, they started to drop rates significantly after that. And then you see rates started to rise here and didn't start to come down until the panic hit. When the real estate market bubble just burst, and then rates came down. And they've been down for a long time ever since then, right? And they started to go up in 2018, and now they're back down. But you'll see the ebb and flow of economy and markets is impacted by what the Federal Reserve does. So I thought we'd also put, here's the 10-year Treasury rate. So this rate is set by the markets, right? The markets didn't think the Federal Reserve was serious, so rates went all the way up to 15.5%, 16%. Mortgage rates oftentimes use this as a barometer. And so you saw, again, these rates didn't start coming down until they knew that the Federal Reserve was serious about inflation. And you'll see over time that, yes, recessions hit, but the rates have continued to come down. Some have posited that this 40-year trend still hasn't ended. You still have rates are down here as we're going to record this today. The 10 years at 1.8%. So again, they have operations that impact it through the quantitative easing or quantitative tightening, where they're putting additional money in the market, where they're buying securities in the market. But now you see that the Federal Reserve, at this point now, their seriousness of fighting inflation had been questioned until Chair Powell in recent weeks now has let it be known, and the markets are believing that they're going to make inflation and the concern of that a high priority. So in the end, wrapping up, financial markets set the price of long-term interest rates. Congress, has a material impact on the cost of money over a long period of time if they have excessive spending. And Congress and President can put on trade tariffs, which hurt. They can do other policies which can help or hurt the economy, but not to the extent of what the Federal Reserve does. So hopefully we've been able to at least paint an overall, a broad brush of an understanding. We can follow up with more. If you have questions, certainly respond to us with this, and we'll look to talk to you in the future. And best of luck to us all.